had a bunch of price alerts go off on my screen this week. It doesn't often happen, mostly because I set them quite a while ago, and I set them under numbers that they were at. But 3 of them went off, and one of them I had to look up what it was. Listeners at home and viewers at home as well, see if you can work out what links these 3 stocks. I'll tell you their ticker symbols. You can tell me what theme is. So the first one is BNL, which is on the New York Stock Exchange. The second one is SLG, which is also on the New York Stock Exchange. And the third one is RMV on the LSE, the London Stock Exchange in this situation. So my guess is that nearly no one will know what the first one of those is. It's not one I hear talked about very often. The second one, I think people, when they find out what it is, will go, oh yeah, but they won't necessarily recall it. And the third one is Rightmove. So these are all basically property-based things. The first one is Broadstone Net Lease. Can't remember why I put a thing on that, to be honest with you, but that came down along with a load of REITs. And this, I said it so long ago, I now can't remember what it was or what it did, but I've had another look, and I'm going to keep looking at that for the time being. SLG is SL Green, the office REIT in Manhattan, which at the time I set that alert was upping its dividend and paying out a big special one as people were making noise that no one was ever going to go back to an office ever in the middle of the COVID stuff. But the one that's really catching my eye at the moment is Rightmove, which has been falling in response to all that stuff we were saying about house prices not so long ago. Earlier in this show, in fact, sorry. They've been buying their stock back over the last couple of days, Steve. This only kind of came across my radar today. They've been buying back sort of 0.02% on one of the days and 0.03% today, Wednesday, as we record this, and then another kind of fraction of a percent on Monday. They're quietly buying bits back here. I'm not sure whether they do that kind of mechanically or whether that's because they think it's particularly good value at the moment and it's discretionary, but this has come down an awful long way. It's now it's gone under a $5 a share, which is where I once owned it and then sold it at 5 something a share because I thought I would never build a big enough position in it, and now it's come back into interesting territory again. There is some macroeconomic headwind, to put it mildly, on this. The UK property sector, when I talked about this, actually, you asked me whether I was worried about the UK property sector as being a bit hot at the moment as a reason to avoid buying this at that moment, and I said no, and I think I still stick by that thought, but looks a lot more attractive now.
Yeah, it definitely does. I've been buying this one as well, Steve. I bought a little bit in the, I think it's the mid 500s, but it rapidly lost that ground, and I said to you, so where are we buying this? Do you know what I mean? Where's this going to end up? I guess Rightmove's lifeblood is listings, and if we think that perhaps there's going to be a slowdown in listings, a slowdown in moving, then that could. That could be some material weakness for Rightmove, I guess. But you've got to think about the times that we're about to go into. Hopefully, will not last forever. I think you wouldn't buy Rightmove if you were going to be a pessimist about the UK's property future. I think that would be a terrible move. But if you think that the UK's housing industry will get back to sort of the same levels that we were, before the pandemic, then this stock looks really, really attractive at this kind of price at the moment. And, if you're happy to sit in it and wait, you're getting nearly a 2% yield, which is pretty well covered. A company that's happy to buy back its stock when, the price is going down, which, for me is really, really sensible. It's a stock that's traded at a premium for probably the best part of 5 years now. So to see that premium be wiped out by, yes, higher earnings and a declining stock price, I think it looks really attractive at the moment. I'd be interested in buying quite a lot more.
So would I. If you look at this on the Yahoo Finance kind of mobile app stuff, for what it's worth, gives you a nice kind of chart of revenue and income, or I suppose anywhere that offers you those kind of graphs, you will see pretty much everything going in the direction you want it to be going in. It's just every block is higher than the previous block. That ain't going to last forever, fairly obviously, and it probably ain't going to last another year, the way the property market is going. But the question, I guess, to keep in mind then is, well, look, how far off do you think it's going to come? Do you think it's going to go back to 2021 levels? Do you think it's going to go back to 2018 levels? Do you think it's going to go back to 2020 levels? The pandemic year in there, and so on and so forth. I think that there's a bit of a theme coming back here with one of my later stocks here. I think this is an overreaction, the amount of market cap they're losing for the amount of earnings I think they're going to lose. That kind of implies that only matters if you think they were priced correctly before their stock started coming down, and I perhaps thought they were a little expensive. But I do think there's a lot more come off this stock than ought to have for the moment. So I'm looking quite carefully at that. And this is a really good example of one of those where you want to think to yourself, well, look, it's not cheap just because it's down. Nothing is ever cheap just because it's down. It's cheap because it's gone down past a certain level, and you want to form your own view of what that level is. And I think I have mine, and I now have an average of 490 on this. I don't normally say what I'm buying because, well, I have a big thing about how no one should ever really believe a YouTuber when they do that. So believe me or not, I don't mind. But yeah, averaging 490 on this, I'm kind of reasonably happy there.
And I guess it's a company that, people will look at and say, look, it's got a PE of 22, it's got to come back down. But, I mean, this is a real premium company. They're churning out nearly 60% net margins, not gross margins, net margins. I mean, there's companies that don't do that gross. I mean, Beyond Meat can't even make any money gross margin. So, and people are happy to pay a valuation which is far more than what you'd be paying for something like Rightmove, which is, I think it's one of our little, we do say that we don't have many tech businesses in the UK, but I guess really we should look at Rightmove and say, this is a business with, which is essentially tech with incredible margins. It's kind of a, sort of a bellwether for just how tech can be if it was fully optimized to churn a profit. The only issue you have with things that have a 60% net margin is that somebody wants to come along who is happy to take a 50% net margin, and that tends to mean there'll be a squeeze on them. But Rightmove have been very good at batting these kind of competitors away. But for me at the moment, I think, I'm still buying it. I can foresee some short-term pain, but I think buying in these kind of moments, a stock like Rightmove is a pretty good move for my money.